Hello everyone, here is the answer to exercise 1 for unit 1 of AC201. In the first journal entry, Greenview Corporation is going to issue 10,000 shares of $2 par common stock, and they're going to do so at a market price of $20 per share. Well, to figure out what journal entry we have to record, we first have to figure out what accounts are going to be affected. Well, if Greenview Corporation is selling stock, they are doing so for the purpose of receiving cash. They're getting funds to expand their business. And then two separate equity accounts are going to be affected. One being common stock and one being paid in capital in excess of par on common stock transactions, which I always abbreviate to PIC common. What types of accounts are these? Well, cash is an asset, and as I just said, the other two are both equity accounts. Are they increasing or decreasing? Well, if we're selling stock to raise cash, then the value of our cash account or our bank account has to be going up. So we're going to have an increase there. Common stock tracks how much stock you have issued in order to raise money, but it only tracks up to the par value of the stock. But we're issuing more stock, and since we're issuing more stock, the value of our common stock account also has to go up. And then paid in capital for common stock transactions tracks how much your investors paid into your company in excess or above the par price of the share. And since we have $2 par common stock and we're selling it for $20, they're paying in a lot extra above par, which means that account also has to be going up. Cash as an asset is going up, and all assets always go up on the debit side. Both common stock and your PIC account are equity accounts, and they're going up, and equity accounts always go up on the credit side. So we know our journal entry is going to have one debit to cash and two credits, one to common stock, one to PIC common. So in our February 1st journal entry, let's start by debiting cash, and we're going to debit it for an amount equal to the amount of cash we're receiving. We can find that by taking the number of shares that we are issuing and multiplying it by our sale price. We're selling 10,000 shares at a market price of $20 a piece, which means Greenview Corporation is going to receive $200,000 in cash. For our credit to common stock with a $2 par, we are going to figure out how much to credit that for by taking the number of shares issued and multiplying it by the par price of the stock. So 10,000 shares issued, $2 par means $20,000 of that $200,000 we're raising can be attributed to the par price of the stock that we are selling. The rest of it can be attributed to money getting paid in capital in excess of par. So our credit to PIC common is simply going to be for whatever makes our debits equal our credits. Or if you want to think about it another way, it's equal to the number of shares that you have issued times the difference between market price and par price, or the amount in excess of par they are paying for shares. It's $20 market price, $2 par, which means they're paying $18 extra per share. Well, $18 extra per share times 10,000 shares would give you that same $180,000. So that is our journal entry to record the issuance of common stock above par. In journal entry number 2, Greenview Corporation is going to sell $15,000 worth of inventory, and they're going to do so on account. And this inventory originally cost Greenview $9,000 to purchase it. So whenever you make a sale, it's going to require two journal entries. One which is going to record the revenues, and the other one that's going to record the expenses. So let's start with the revenues. What are we doing to make money, and how are we being paid? Well, we're selling goods, so we know sales revenue has to be one of our accounts. And how are we getting paid? We're getting paid on account. We're not actually getting paid. We're billing them. But it's still an asset. They still owe us the money. So accounts receivable is going to be the other account affected in this journal entry that records this transaction. AR is an asset, and it is going up. So assets always go up on the debit side. Sales revenue is a revenue account, and it is going up. And all revenue accounts always go up on the credit side. So as you can see on your screen, the journal entry to record the revenue portion of this sale would be a debit to accounts receivable for the amount of the sale, which was $15,000, and a credit to sales revenue for $15,000. Well, where's the $9,000 they originally purchased it for? Well, that comes in the second entry that's required for whenever we make a sale, and that is the entry to record the expenses. So the two accounts are going to be affected here. Cost of goods sold is the expense that we recognize every time our company sells merchandise inventory or finished goods inventory. In this case, it's merchandise inventory, so we're going to credit merchandise inventory to lower the value of that account because we need to reduce that asset because we don't have the inventory anymore. We sold it. So Cost of goods sold is an expense account is going to be going up, and expenses go up with a debit. We're decreasing the value of our merchandise inventory, and when we decrease an asset, we always do so with a credit. So the entry to record the expense portion of this transaction is going to be a debit to COGS and a credit to merchandise inventory for the price that we originally paid to acquire this inventory, which is $9,000. And the next journal entry on February 3rd, Greenview Corporation is going to prepay $3,600 for 3 months rent, spanning the months of February through April. So we can't record this as rent expense because we haven't used it yet. We can't put the expense on the books until the period where it actually helps us earn revenue. So at this point, it's not an expense. What it is an asset. It's something we're going to use in the future to help us make revenue. So we're going to record it under our prepaid rent asset account, and since we have more rent prepaid in the future, that has to be going up, so we're going to debit that. But we are handing the cash over right now, which means our cash is going to decrease, and like all assets, is going to decrease on the credit side. Therefore, this February 3rd journal entry is going to be a debit to prepaid rent for $3,600 and a credit to cash for $3,600. On February 5th, Greenview is going to purchase $7,500 worth of inventory on account. What are we buying and how are we paying for it? We're buying merchandise inventory and we're paying on account. So our two accounts being affected are going to be our merchandise inventory account and our accounts payable account. We're buying inventory, which means it has to be going up, and since it's an asset and it's going up, it's going to go up on the debit side. Accounts payable is a liability. We owe something. In this case, we owe this vendor money for the purchase. And since we owe more, that liability account is going to go up, and like all liability accounts, it's going to go up on the credit side. So this journal entry on February 5th is going to be a debit to merchandise inventory for $7,500 and a credit to accounts payable for that same amount. On February 8th, Greenview is going to receive payment in full for the inventory they sold on February 2nd. Again, we sold $15,000 worth of inventory. Well, what's going to happen here? We're getting paid, so we're getting the cash, so our cash account has to be going up, and it's an asset. All assets go up with a debit. The other account being affected is the account that showed how much money people owe to us. They don't owe us anymore, so we can't have that receivable on the books because we're not eligible to receive anything at this point. Their debt has been paid off to us. So we need to decrease the value of our accounts receivable. It's also an asset, and assets, since they go up on the debit side, have to go down on the credit side. So the journal entry for February 8th is going to be a debit to cash and a credit to accounts receivable. On February 11th, Greenview is going to pay in full for the $7,500 worth of inventory they just purchased a couple of slides ago on February 5th. So in this entry, just like the last one we had, debt's getting paid off, but now we're paying off our own debt to somebody else, which means we can't have that liability on the books anymore because we're not going to owe anything after we make this payment. So we need to reduce a liability, and accounts payable is a liability. So like all liabilities, it's getting reduced, and it's going to get reduced on the debit side. What else is going down? Well, we're handing out the cash from our bank account to the people that we owed money to for the purchase of this inventory to our vendor, and cash as an asset is going to decrease, and all assets decrease on the credit side. So our journal entry is going to be a debit to accounts payable for $7,500 and a credit to cash for the same amount. On February 14th, Greenview is going to borrow $50,000 by signing a 2-year 4% notes payable with a local bank. Well, in this entry, what's happening? What two accounts are being affected? Why are we signing a note? Because we're borrowing money. And since we're borrowing money, our cash has to be going up. And since cash is an asset, as we've said before, it's going to go up with a debit. What else is going to go up? Liability. We have to pay this back to the local bank. But our liability this time is not accounts payable because we're borrowing for the purpose of getting money. Therefore, it has to be notes payable. We had to sign a promissory note saying we were going to pay this back. So notes payable, liability going up, and all liabilities go up with a credit. Journal entry in this case is going to be done on February 14th. We have a debit to cash for $50,000 and a credit to notes payable for $50,000. On February 16th, Greenview is going to purchase a $20,000 piece of equipment in cash. What are we buying? How are we paying for it? We're buying equipment in cash. Those are the two accounts being affected. They're both assets. The amount of equipment we have after this purchase is going to go up, while the amount of cash we have is going to go down. And all assets go up with a debit, down with a credit, which means equipment has to be our debit, cash has to be our credit. The February 16th journal entry is a debit to equipment for $20,000 and a credit to cash for that same amount. On February 27th, Greenview Corporation is going to receive a $1,000 utility bill that they're not going to pay until the following month of March. But that bill is for utilities that we use during the month of February. And that matching principle by GAAP says that we have to record expenses in the same period that they help us earn revenues. So even though we're not going to pay this bill until March, because those February utility expenses helped us earn revenue in February, expense has to go on February's books, which means we need to record the utility expense during the same month that we actually use the utility. So that's going to be one of our accounts. And utilities expense is an expense account. It's going to be going up because we're paying for more utilities during the month, or we're putting more utilities on our books during the month, I should say, which means that, like all expenses, it's going to go up with a debit. We're not going to credit cash because we're not actually paying it the next month, but we know that we owe it. And since we know that we owe it, we have to create a liability. In this case, our liability is going to be utilities payable, and that liability is going to increase like all liabilities on the credit side. The journal entry on February 27th is a debit to utilities expense and a credit to utilities payable. And then lastly, on February 28th, Greenview is going to declare a $15,000 cash dividend, which will be paid in the future on March 15th. So we're not actually paying it, but we declared it. And at the time that we declare it, we have to withdraw that money from the business. We have to at least, say that we're declaring these dividends. So when we do so, we are going to debit our cash dividends withdrawal account. And like all withdrawal accounts, it's going to be going up because we're declaring more dividends, and like all withdrawal accounts, it goes up on the debit side. We're not actually paying the dividends until the following month, so we're not going to credit cash. We have to create a liability, just like we did in the last entry. This time the liability is for dividends that we're going to pay in the future, so our credit is the dividends payable. So the February 15th journal entry for the declaration of these future dividends is going to be a debit to cash dividends for $15,000 and a credit to dividends payable for the same amount, to record the journal entry where we declared a cash dividend.